Hello, guys. Thank you very much for joining in. I'm doing a quick session on making people understand what could be the important concepts from the book Investment Management and also current issues. So we're going to be going through all the chapters, and I'm going to highlight which concepts within the chapter could be important for your exam or which page could be important for the exam. And as per that, you can prepare and go for the exam. So with this, let us start with the first book, which is the in risk management and the investment management. Now, when you look at all of these concepts, okay, the first two chapters, which is the factor theory and factors, they are primarily based and connected to CAPM logic. There are some concepts on this. These two chapters are important, but when we move towards alpha, which is a very very important chapter as per the exam perspective, so please make sure that you are focused on that. Okay, portfolio construction slightly tricky, slightly complex chapter, not so very very important as such. Okay, portfolio risk analytics, double star, very, very important. All the concepts, managing portfolio with VAR is very important. The next chapter is also very important, VAR and risk budgeting. Both of them actually check your understanding from level one also, whether you've been able to understand VAR and in connection with portfolio management or not. The next part, all of these chapters more or less are theoretical chapter, risk monitoring and performance measurement, more or less. This chapter is slightly important, performance portfolio performance evaluation. Certain part is connected to level one. That's the reason it's slightly important. Hedge fund is again repeat from level one. Some component is repeat from level one. Due diligence and all of this till the predicting fraud by investment manager is kind of slightly easy, slightly theoretical, not very very important chapters, but few concepts which I'll be going through now for the first book, which is risk management and investment management, we'll be covering over here. So when we go towards the first chapter, I'm just directly taking you towards the factor theory. Okay, in this factor theory, I'll be highlighting important parts also for your reference. So, for example, the this part, okay, what does factor theory properly talks about, that this part is important. I mean, this entire section is important. Okay, as we move towards the lessons that we learned from CAPM, okay, that lessons are very important, and out of that, the lesson number one is important. Okay, all of this, the diagram, this paragraph which talks about equilibrium, important. The students should be clear on what is happening over there. Then the next part, the lesson number four, factors, which talks about risk exposure. Okay, so when we talk about any particular asset, we are talking about our exposure to that risk asset that has been covered. So this entire thing is important, and this formula is also important. So mark this as star. Okay, as we move ahead, this lesson number six is also important. Valuable assets have low risk premium, okay, which basically connects with the logic of beta, which is again going to come in your further chapter. Okay, so these three lessons are very, very important when we talk about CAPM. When we talk about the shortcomings, okay, the second point, the mean variance framework utility, very, very important. Fifth point, frictionless part. They have discussed about why in real world you don't see markets as frictionless. There are certain points which are there. And then again, individual investors are price takers. So all of this as are important pointers with respect to what can be the problem with CAPM. As we move ahead and go towards the next part, the multi-factor model comes into picture, which is the arbitrage pricing model. We have already seen that in level one. The lessons are more or less similar to Captain, so not very important. Pricing kernel also, the concept as such is not very important. Very, very less chances that they might test you. But this paragraph is what you should focus on when you're reading the concept. Okay. So I'm just highlighting those that important paragraph. Rest all is more or less not so important. Efficient market theory. Okay, you can read this first paragraph. Make sure you're comfortable with that. And as we move ahead, these two paragraphs are important. So marking them, what are the explanation? Why do we see an efficient market hypothesis being implemented in the market? Okay, why certain behaviors are happening? So they've given rational and behavioral explanation to it. So that is important for the exam. Okay, with this, if we are done with the first chapter, we are moving towards the second chapter, which is the factors. So we completed factor theory. Now we're going to be talking about individual factors which are below the asset. So when we move ahead, okay, the concept of value growth theory, I purposely marked it. So all this part is important. Do not skip that. As you move ahead, economic growth, this paragraph is important, and this part is important. Please don't omit this when you're revising the concept. As we move towards inflation, fairly okay. Volatility as a concept is very, very important. Mark this as star, the entire part, including the leverage effect, okay, and the discussion on the X. Important. And these two things are also important. Okay. How does leverage effect actually works? Other macroeconomic factors, I don't expect much questions to be tested from this concept as such or this part as such. So we can when you're revising, you can kind of skip it or you can do it very fast. Let us go to the next learning objective. Over here, this part is very, very important. How can you harness volatility? Okay, so because of these pointers, they have given you the logic of how do we make sure that volatility premium is generated. Okay, when you sell a particular option, you can make some premium out of it, but how volatility can have an impact on it. So that is also being discussed over here. So marking volatility premium also as star for your reading from that particular chapter. Okay, this is the same formula which is repeated from the previous chapter. The basic understanding of the formula is necessary, is very important, hence marking this as star. As we move ahead, this part, which is the pharma French, I'm not highlighting it as star as such, but this is just a repeat from the previous section. The important part will come into picture, which is over here. One second. This part you should know. I've not highlighted in the chapter as such, but this is important, helping you to understand what does the beta of HML or SMB represents. That is also important for your understanding. Okay, let us move towards the next section, which talks about value and momentum investing. In that, this part is worth reading, marking this as star. Okay, why do we see the size effect getting disappeared? The SMB part getting disappeared when we look at various portfolios. That is important. With respect to value investing, uh, there's a concept of this rational theory, this paragraph, and when we move towards behavioral theory, behavior is more important. So extrapolation and the loss aversion, both of them are very important. The concept can get tested in case studies also. So please make sure that you are clear on these two topics, especially loss aversion. As we move ahead, more or less the other points are not so important. Momentum investing, the basics should be clear. What is happening? Winners minus losing part is should be clear in your mind. This part, the positive and the negative feedback loop, is important. So marking this as star. Rest momentum investing is more or less there. This paragraph is also important. Overreaction and underreaction. This has been tested in the past exam. Okay, hence I'm marking it as double star. Let us move towards the next chapter, which is the alpha. Overall, I have marked this alpha chapter as double star because I expect good questions or good connected questions to come from the exam perspective. Low risk anomaly part over here, the concept of tracking error, you should be clear on, and the active return part should be clear. Benchmark selection. Now, over here, this entire part or the discussion that how do we see CAPM in a very different way, okay, and which tells me how much weightage I put in on particular risk-free asset or how much weightage I put in on a benchmark. That understanding has to be very, very clear. And also this part, okay, this part is very, very important. How do we define a particular benchmark? Okay, because if you're everything depends upon what is your definition of benchmark. Because by comparing benchmark, you're actually talking about whether you're made alpha or not. So, what are the properties and all? You should be clear on that. It's very, very important, marking it as star. Fundamental law of management, double star, this formula. You should be clear what is information coefficient, what is breadth, and what point they are trying to highlight. Either you play very hard or play very smart. The logic has to be very clear. Okay, I'm marking all of this as important from the exam perspective. As we move ahead, regression analysis part. Now the discussion which is happening over here, that discussion is important. Okay, why are we giving up at what does this beta represents? Okay, positive beta, negative beta represents. Again, when we talk about CAPM, they have shown you the table and all. The main point is the discussion. What does this negative beta represents and what does the positive beta represents when we talk about the Berkshire Hathaway data. Momentum investing, again, winner minus loser or up minus down. Logic, again, the main part is the discussion. Okay, what is this analysis of regression is primarily telling us? Okay, so This part also should be read properly for the exam perspective. Measurement of time, a varying factor, is not so important from the exam perspective. Issues with alpha, kind of slightly important. So you can read the first paragraph. Okay, but when you compare with other topics, it is slightly less important. Volatility anomaly and beta anomaly as a concept, you should be clear. Marking this as star. Beta anomaly is very, very important, and hence I marked it as star. Risk anomaly part, not so important. So we're going to be moving towards the next chapter now. The next chapter talks about your construction of the portfolio. Okay, all of these, the constraint that you have when you create a portfolio, very, very important. Mark it as star. Okay, as we move ahead, this part, the scaling and the trimming of alpha, very, very important. So this entire section, okay, is important, when especially with respect to how do we refine the alpha. And over here, they talked about the scaling of the alpha. Neutralization, not so important, so I'm just moving ahead. Benchmark neutralization, to a certain extent, you should know what is happening over there in terms of theoretical part. Understanding has to be there. Transaction cost, double star, very, very important. Okay, they are trying to help you understand how, when you creating a portfolio, you're bringing an asset in, how transaction cost can play a very big role in terms of return that you're generating. So that's why I'm marking it as star. Moving further, practical issues in portfolio management. So over here, aversion to certain risk factor. Mark this paragraph as also star. The next part, portfolio revision and rebalancing. This formula at an overall level you should know. Okay, and because on the basis of that you can identify whether you should go and do a trade or not. Okay, so this actually this formula is also important, which tells you whether the marginal contribution that you're doing by adding a particular asset is between that range or not. Okay, portfolio construction techniques, screening, stratification. You can think about screening as slightly important out of all the approaches. Stratification is fairly simple, not so important. The quadratic one is also not important. Next is portfolio return diversion. So over here, they're trying to highlight that how two customers can have a dispersion in their return because of the constraint that the portfolio manager face. That has also been highlighted over here. You can read this section. The next part, oops, the portfolio risk analytics chapter. Okay, the VAR measure, diversified portfolio VAR, important formula, mark this as star, similar to what you have done in level one. Okay, uh, the concept of individual VAR, marking it as star, uh, the correlation part and the VAR for uncorrelated part is very important, marking this as star. Also, this first sum should be clear, second sum should be clear again. Moving further, less likely that they will ask you this formula. Marginal var, very, very important in terms of the entire concepts. Okay, and also this formula of marginal var is important. Incremental var, not so important, because most of the time we use marginal var as a reference and talk about what is the change that is happening. Okay, this sum is slightly important. Again, this sum tells you whether you can take a decision of that additional investment into a portfolio or not. Component var, very, very important, especially this formula. And please make sure that both the questions you are comfortable with. And sorry, the third question also. Next, moving forward, managing portfolio with VAR. This is okay. One second. Okay, this part, you should know what are they doing. See, in the exam, they might not ask you a very detailed question, but they might test you on the logic of how do we change the portfolio size or weightages to reach to a particular marginal VAR level. Okay, so that understanding has to be clear. Let us move towards the next section where we are talking about VAR and risk budgeting, also very, very important from the exam perspective. Now, over here, this table, mark this as star. Okay, the investment process, the first, second step important, mark this as star. Hedge fund issues are okay. Yes, the absolute and the relative VAR is very, very important. And the concept of policy mix and active risk, very, very important. It basically tells you whether you have done the asset allocation, is it actually bringing in the amount of risk, or the security selection is bringing in the risk. That is important. Funding risk, the surplus at risk primary concept. This is important. This part, what does surplus at risk means? Very, very important, marking it as star. And they have also done a calculation over here. This sum is important. And the concept of surplus, this again, double star. This sum, this is being tested in the exam, in the previous exam, surplus at risk. So please make sure that you do not skip it. Okay. And the concept of economic and cash flow risk. This was tested in theory in the previous exam. So do not skip it. Monitoring risk with VAR, more or less. Okay, that's more theoretical part. VAR application, investment guideline, investment process, theoretical part. Budgeting risk. Okay, this question should be clear in your mind. Information ratio is okay. That is more or less which manager is doing better. Okay, you can expect a question like this. So mark this as star. Okay, and look at this example again, marking this as star. I'm going to move towards the next chapter, which is now a slightly theoretical part, risk monitoring and the performance measurement. Over here, the concept of tracking error is okay. Risk planning is also okay. Yes, risk budgeting, marking this as star. Monitoring is okay. Risk management unit. This concept can get tested in the exam. Objectives, they might not test you. Okay. You can look at this entire part and specifically the style drift. How different managers, their style is different, and how correlation among them can increase the risk of the fund. Liquidity duration, yes, important. These simple theoretical, simple, easy questions can come in your exam. So do not miss, remember the formula for the exam. Performance part, return attribution, this part is important. So when you're looking at a portfolio, you're getting a return. Which part is giving you that return? Okay, so return attribution is important. Alpha benchmark, survivorship bias, you should know at an overall level. We're going to move towards the next section, the next chapter, which is portfolio performance and evaluation. Now, as we move ahead, time weighted and dollar weighted return, more or less, they will be testing you on the time weighted return. So I'm marking this as double star. Okay. And risk adjusted performance part, more or less sharp trainer is repeat. Okay. The concept might get tested. So not exactly the formula as such, but the concept and why we are using sharp, why we are using trainer, that might get tested. For Jensen's alpha, the understanding part will get tested more likely, and for information ratio also. M square, marking it as star. This has been tested in the past exam. Okay, especially the diagram. They have shown the diagram and try to ask questions related to it. So please make sure that your entire M square concept along with the sum is aware. So you are clear on that part. Next, this is more or less the n square repeat. Statistical significance of alpha. Primarily, they are doing hypothesis testing. Performance evaluation with dynamic risk measure. Regression with market timing. You can read this part, the call option model. Style analysis, okay. So all of this is not heavily tested in the exam. I've not heard about it. Okay, so let us move towards the next chapter. Hedge fund, more or less hedge fund strategies and what hedge funds do. Okay, characteristics of hedge fund, theoretical, not so important. Selection bias and self-reporting bias. These bias can be tested, so please make sure that you're good at it. Impact of institutional investor, okay. Alpha beta separation, this part. Marking it as star, important. Hedge fund strategies, manage future and global macro, not so important. These distress security and merger arbitrage, very, very important. Swap trade, okay. Long short equity can get tested. Rest is how the performance of the hedge fund looks. Convergence of risk factor, more or less theory. Risk symmetry can be tested. So read this part properly. Let us move towards the next section, performing due diligence on specific managers and funds. Okay, again, we are looking at portfolio, the entire fund house. We have different fund managers. How do we are comparing between them? So failure of the hedge fund section, more or less, this point you can focus on. Fraud we can focus on, and lack of liquidity we can focus on. Due diligence element, this paragraph you can focus more on. Managers evaluation, more or less, not so very specific point that I can highlight. Ownership, track record, investment. These are just questions which you should check when you're hiring a fund manager. Risk managers evaluation, security leverage part, definitely you should look at. Exposure to tail event, should look at, more or less that is there. Performance due diligence, you can focus on this paragraph. Document and disclosure, more or less a theoretical part. Service provider business model risk. So when you are giving out vendor some details, you can just read this part. This can be important for your reference. Questionnaire, not again very important. Theoretical aspect of it. Let us move towards the next section. Predicting fraud by investment management managers. This chapter was changed. The name has changed, Madam, but the core concept of the chapter is still the same. Okay, the form ADV part. Okay, this entire part section is very, very important. So do not miss it. Okay, mark this as star. The entire, all of these bullet points. Next, fraudulent misrepresentation, cost of fraud prediction. Next, this part is also important. So marking this, and this chapter is small and easy, not so very lengthy. Now we are entering into the current issues part. I'll again cover this entire book of current issues chapter by chapter with respect to the important concepts. Machine learning and AI for risk management, the first chapter in that. The supervised learning, what exactly is supervised learning? What are the different types of supervised learning you should be clear on? Principal component analysis, you should be clear. This is also there in level 1. Under the classification method, more or less okay. Unsupervised clustering and neural network part. It should be clear for you all. So marking it as star. The usage of the machine learning and AI. Read the first paragraph of credit risk. These two paragraphs of market risk. Operation risk is okay. Regulatory RegTech. RegTech can get tested in your exam. So read it properly. Limitation of AI. This can be tested. These two paragraphs, marking it a star. And then we can move towards the next chapter again, which is related to artificial intelligence. The second chapter, AI in risk and governance. We're going to move toward that. Over here, the ALMA attack part, marking it a star. Data poisoning, model extraction, all of them is important. Biasness, which can impact your trust on the data, on the process, is important. AI governance section, the inventory part is important. The framework part is important entirely. The framework part till this paragraph is important. Third party management, okay. You can also have this part as important, marking it as star. Challenges that we face in introduction to AI and ML in and the system. Discrimination, very, very important, marking it as star. Inconsistent explanation. This is also important. So read this part for your exam. Oversight and monitoring. Monitoring for drift, important. Enhancing. This paragraph is important. Read when you're reading, please focus on these paragraph, and differential privacy is also, you should read what it is. Let us move towards the third chapter, from your book, COVID-19 and cyber risk in the financial sector. Okay, defining cyber risk. Now, over here, the concept is that the cyber attack, which is the man in the middle, very, very important, marking it as star. Phishing, very, very important, marketing as star. Both of these, zero-day exploit and DDoS, important. Then, what happened with respect to the problem? So, we can read this paragraph and the last paragraph, the walkthroughs part, as a reference that how should we tackle the COVID-related cyber attack risk. Holistic review of the March turmoil. So during 2020, when the COVID happened, market reacted. So this entire chapter talks about that. Okay, dash for cash, important. Market as star. Next is third stage of market turmoil. What's important? One second. You can read this, changes in the pricing relationship and stress. You can also read this. And then as we move ahead, NBI, non-banking institutions, the US dollar funding part is important. Demand for liquidity and credit held outside the banking. You can read this entire section. And then we can move ahead towards the next learning objective. Money market mutual fund, open-ended mutual fund, how they got impacted. Repos you can focus on, and CCPs you can focus on. Short-term market funding. The first three paragraph of corporate bond and the government bond. Policy response, asset purchase, central bank asset purchase section is important, marking it as star. Targeted liquidity support, important. Lessons what we have learned. Okay, in this, the key lessons, I think so all of them are important, so please do not skip it. Marking this as also star. Let us move towards the next chapter. As we move towards the LIBOR transition case studies, they have given you a few case studies of how LIBOR is going to move and what how the banks should give how should banks should give deals to their existing customer. That is being discussed in more detail. SOFR is primarily going to where the movement is going to happen. So the conduct risk consideration, the risk identification, all of this is important. This is the base that they're saying that when we are moving from LIBOR to some other rate, what are the risks that we might face at a broader level? Okay, all of these are important. And fair treatment, okay, market conduct. The case study starts over here. So good practice applicable to bank. The first case study is very important. You can also read the good practice part. The first case study is important and the second case study is important. Rest, I think so, is more or less not so highly tested, the C and D part. So we can just read it and move to the next chapter. Next chapter is beyond LIBOR. Important, very, very important from the reference perspective. Okay. And in this, the ideal part of the benchmark, this is important. Okay. You should definitely read this part. Shortcoming in the LIBOR, this part, why are we moving from LIBOR? What problems we started facing? That is also important. Then they have talked about this, not exactly the table. See, this entire thing they are talking about why particular SOFR is being used. So the three characteristics that it should be overnight, wholesale, market driven, and secured. That understanding has to be clear. And then as we move ahead, this part, the inherent risk that we see, this is important, marking it as star. Okay, this entire chapter is overall important, but I've highlighted few sectional part which you can refer to. Climate and climate related part, physical and the transition risk, that is what is more importantly talked about. Transmission channels important, climate related risk drivers are important. Now, when we talk about climate related risk drivers, the first paragraph which talks about the transition risk and the physical risk important. Within the physical risk, acute and chronic, both of them very, very important. Transition risk drivers, in that technology important, consumer sentiment and investor sentiment important. Drivers, transmission Channels, okay, you can read this part for the exam. Rest, we can move towards, sorry, market risk. Okay, you can read the entire market risk part. Operational macro transmission channels. Okay, factors that impact geographical heterogeneity, first paragraph. Financial system. Is financial amplifiers important for reading perspective? Bank, litigants. You can read this part, marking this as star. Insurance is okay. Capital markets securitization, okay. So rest of the chapter is fairly not heavily tested in the exam. This is what I feel. Let us move towards the next chapter, the rise of digital money. This was previously there, and then again they have added it. So I'm expecting in this exam they might test you good on this concept. Okay, you should remember the chart, basically talking about the characteristics or the attribution for each money. So over here, this entire part, marking it as star. Characteristics of e-money section. This paragraph is important. Okay, all of this convenient. You should remember, marking it as star again. Next is monetary policy transmission risk. I'm highlighting this. There are different scenarios that they have given you how e-money and banking can work together. Okay, in one of the cases, e-money might be aggressive, in another case, banking might be aggressive, all of that. Okay, so the coexisting scenario is important, takeover scenario is important. Okay, let us move towards the regulatory action for mitigating e-money risk. Okay, so this entire part is important, marking it as star. Rest everything is okay. You should also remember the concept of this synthetic central digital bank currency. Okay, the overall concept should be aware. So with this, I think so we are done with the current issues chapter also. Okay, I hope this video is helpful for all of you guys. If you like my videos, do subscribe to my YouTube channel.